Guys, as you know, the Federal Reserve began a program to reduce their balance sheet starting, I don't know, less than a year ago or so. So, what they're doing is the opposite of quantitative easing, where they would buy bonds and put them on their balance sheet. They're now taking these bonds off either by selling or just letting them mature and getting the cash for them and not buying new bonds. So, this is supposedly quantitative tightening. So, how far have they gotten? And what has changed in the last week with their balance sheet with these new bailouts? We're going to look at that in a minute. But think of it like this: if quantitative easing is the Fed driving down the street at 100 miles an hour, quantitative tightening is like them tapping the brake just a little bit to slow them down to about 80 miles an hour. Well, now with these bailouts, they are either taking their foot off the brake or they are putting their foot on the gas a little bit stronger. And so the net result is their speed is increasing. So let's take a look. So Zero Hedge has this article, Fed's new BTFP, meaning the Bank Term Funding Program, or by the FN Pivot facility, is stealth QE injecting up to $2 trillion in liquidity, JP Morgan says. So they can make up all kinds of new fancy names for these programs and facilities and term funding and blah, blah, blah. Never listen to what they say, watch what they do. So this BTFP is designed for banks that are facing deposit outflows from being forced to sell their bond holdings at a loss. So they bought all these longer term bonds at very low interest rates, like 1.5% on 10-year bonds. Now rates are higher, so they are holding a loss on those bonds, some in the vicinity of 10 to 20% on the par value of their bonds. But no worries, because the Fed will be accepting eligible collateral at par, which at the same time maximizes the capacity of banks to borrow from this lending facility. So that's like saying you bought Google at 100, but now it's at 80, and you can turn it into the Fed and they will give you a loan for 100. And so even Goldman said that this BTFP is a discount window type facility for the current banking crisis. And the discount window is deeply stigmatizing and could lead to bank runs for participating banks, which is why the Fed won't disclose the name of banks using it for 2 years. So they don't want to disclose the names because it may make people take out even more of their deposits from these banks who are using the discount window. Goldman says many banks say they will only use the BTFP once they have exhausted other funding sources such as FHLB advances, certificate of deposit issuance, and the wholesale debt market. So Goldman says BTFP won't be used much, but JP Morgan is saying they disagree and think that it will. And so JP Morgan strategist says the BTFP is big enough to cover all uninsured deposits in the US. Of the close to 18 trillion of domestic deposits, around 7 trillion are uninsured. And most of those deposits are with the largest banks, which are unlikely to tap this facility. So we believe the max usage envisioned for this facility stands closer to 2 trillion, which is the par amount of bonds held by US banks outside the 5 largest. So outside of the 5 largest banks, there are about 2 trillion in bonds, most of which are underwater to some extent. And there's no limit on the amount an individual bank can obtain. So they can borrow up to the par value of eligible collateral. So it's like saying if you bought $1 million worth of Google and it's only worth 800,000 now, the Fed will take it and give you a $1 million loan. And in addition, while the US Treasury will backstop the BTFP with $25 billion from the Exchange Stabilization Fund, this does not necessarily limit the potential size of this program, as it can be levered multiple times. And the Fed says it does not expect to tap these funds because the loans under the program have recourse beyond the pledge collateral. So they'll lend you $1 million on your $800,000 of Google, but you still owe them 800,000. Even if they take your Google and sell it, you still owe them the difference. So he says the potential usage of BTFP could be rather high. And for an example, just by looking at the uninsured deposits of 6 US banks with the highest ratio of uninsured deposits over total deposits, and all 6 of them are regional banks, we come up with $460 billion. And so he's saying BTFP essentially becomes a new form of stealth quantitative easing, because such a potentially high usage of the BTFP would inject liquidity, i.e. reserves into the banking system at a time when there are signs that reserves are becoming scarcer. So they didn't say they're taking away quantitative tightening, so they're not taking their foot off the brake, but they're hitting the gas even more now. So small banks are now reserve constrained, and the Fed needs to inject reserves one way or another. And what banks aren't reserve constrained? Well, JP Morgan, of course, where their average credit card surpasses 20%, but their deposit rates, and this is from March 3rd, I don't know if it's changed since then, but they are 0.01%. But don't worry, the relationship rates are 0.02%. And if you're a Chase private client savings customer and have over $1 million, you get a whopping 0.02%. So on $1 million, that is $200 a year versus about $45,000 a year if you bought T-bills at 4.5%. So JP Morgan doesn't need your money, apparently. Either that or they are like the port in the storm and everybody is running to put their money in a safe bank, and so they can give you these nothing rates and they're making a killing on that money. And so this is the difference between small bank reserves as a percentage of assets versus large banks. Small banks are here almost at the 0 point, whereas large banks are above 10%. So these smaller banks need to give higher interest rates to attract people to get deposits, whereas these bigger banks don't have to as much. So with the collapse of SVB and deposit flight from other banks, as depositors sought to move their deposits to other banks, there were insufficient reserves to settle the transactions with other banks, and they had to sell debt securities and crystallize their losses. So the BTFP provides some relief, because by injecting reserves when banks demand the Fed to cover their losses on their hold to maturity books, the bonds they expect to hold until they mature, instead of having to sell it early to meet liquidity needs, it effectively serves as a new quantitative easing. So injecting reserves equals form of QE. So is 2 trillion the maximum size of this facility? No, it could get much bigger, because the Fed may have to inject more liquidity into the banks because the banks keep losing deposits to government money market funds. And government money market funds do not generally invest in bank liabilities such as certificates of deposits or bank commercial paper, but their investments are rather confined to T-bills and Fed's reverse repos. In other words, when deposits shift into money market funds, the banking system loses liquidity, which are converted into reverse repos. So the tightening of liquidity in U.S. banks is not only from the Fed's quantitative tightening program, but also the result of the rate hikes that have already induced a $400 billion shift from bank deposits to money market funds over the past year. So this chart tells it all. This is the yields on savings, interest, money market deposit accounts, Fed target rate, and money market fund yields from 0 to 5. And so this is the temper tantrum over here where they started to do tightening and then lost their nerve and went back to quantitative easing. But here they are tightening. And so money market yields are 4.5%. Savings, interest checking is basically 0. Savings is like not even half a percentage point. So people are starting to wake up and say, why am I keeping my money in these no interest things over here in these banks when I could put it in money markets in my brokerage account and get 4.5%, especially when I'm losing about 6% a year to inflation. So at least I'm losing less with these 4.5% than what I'm losing here where they're giving me nothing. And so this is what the Fed's balance sheet looks like when you're doing quantitative tightening in one hand and quantitative easing in the other hand. So here their balance sheet was almost $9 trillion, and it has been coming down as far as about 8.3 trillion down here at the beginning of March. And now we are already back up about 300 billion to 8.6 trillion. So back to the levels of November. And so this looks like this is just the beginning. And so by the time this thing is all over, I would not be surprised one bit if the Fed's balance sheet is clearly over $9 trillion. So in effect, completely reversing quantitative tightening to the point of more quantitative easing. And so banks are typically slower in raising their deposit rates relative to money market funds. And so this gap would rise further if the Fed keeps hiking interest rates. In other words, the higher the Fed hikes, the greater the probability of continued deposit runs. And so the more the Fed's stealth QE facility will be used to replenish reserves among small banks. But even these bailouts of the last few days are still raising the risk that more depositors, in particular large institutional depositors who are way above the FDIC insurance rate, will seek the safety of government money market funds. And so this would mean further loss of reserves being converted into reverse repos, putting even more pressure on U.S. banks to use the BTFP, forcing the Fed to expand its balance sheet so that the lost reserves are replaced. Translation: the longer the bank runs continue, the bigger the Fed's stealth QE goes on. So is the recent jump in tech stocks and gold and interest rates going down the realization that the market now sees that the Fed is going to do stealth quantitative easing? I think their option is to put out this fire that's immediate right now in the banking industry and worry about the rise in inflation that this QE is going to cause. They're going to worry about that a little bit later on, but it will come. So the Fed is kind of stuck between a rock and a hard place. I don't know how this is going to play out, but I don't think these problems with banks are over by a long shot. Invest accordingly.